London has lost control of the global silver market.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money. Now, Live from the Vault is the show that goes beyond the headlines to uncover the truth about the precious metals industry. And joining us today is Kinesis' very own world-renowned whistleblower and precious metals industry expert, Mr. Andrew Maguire. And this week, we'll be answering more questions from you, the Live from the Vault community. So keep those questions coming in, and all you got to do is just click on the link below, the description right here. And you never know, your question may just be chosen for Andrew to answer right here live on Live from the Vault. So let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, once again, it's hard to believe it's been 2 weeks since our last market update. And, just as you predicted, gold has risen a whopping $350 higher into your next gold staging point, alongside my beloved silver breaking out a whopping $6 higher into its next also higher staging point. Now, while you were expecting a fight along the way, I know you were expecting a fight, you also said that you expected the dips, if there were any, to be shallow and aggressively bought up, and they sure have been indeed. Now, Andrew, we've received so many questions, but in fact, 90% of our questions, so the majority of our questions were, do you expect gold and silver to end up at the end of the year? For some reason, everyone wants to know now, the end of the year, Andrew, the end of the year. And so as we close, I guess we're looking at the beginning of the year when we're talking about the end of the quarter assessments. And what we're looking at is, where do you think they're going to be now?
Well, great to be with you, Shane. And with everybody, and thanks for all those questions. I mean, tell you what, there is a lot of good questions there, and it's hard to sort of pick one. So I've kind of amalgamated a few here. So let's try and encapsulate all of these various questions, and start by picking the thread up from our last episode that was recorded on the 1st of October. So we're actually 15th today that we're recording this, and we're going to follow that way. We can follow the footprints, and it makes more sense when you can follow those footprints. So let's take a quick look at the charts. To quickly recap, gold began trading on the fourth quarter, trading at our end of third quarter 38.50 staging point here, and silver ended up consolidating at its 46.50 staging point, and obviously we're looking to follow these footprints. Now, this represents the first 2 weeks of the fourth quarter in October in silver, and the same in gold. And following these 2 solid weeks of gains in both gold and silver, there's been several expected attempts to rein the rallies in both gold and silver, which have really wrong-footed the unallocated Loco-London cartel. Now, this was particularly evident, actually, in silver. In fact, the bulk of our questions revolve around silver, and we'll spend a good deal of time answering them shortly. However, spoiler alert, every attempt to synthetically cap prices, and this is why we're looking at the futures charts right now, each of these attempts have been completely siloed inside the cash-settled CME exchanges, and really has been limited to target the naked long speculators who coattail each fresh leg of very real, physically driven rallies. Exactly the same situation in gold, and each time that there has been an attempt, it has been shallow. And as we assessed in our last episode, each of these sell attempts exposed the LBMA CME COMEX as broken price takers, And with very few remaining real money traders still trusting the COMEX, it severely limited the ability to generate sufficient downside sell ignition that really could cause any lasting damage to what is a physically driven rally. Now, while we see the same in gold, silver always provides a better view of the footprints. Now, the first real attempt for this month occurred into what was actually a coordinated margin borrowing cost. The margins just means borrowing cost to borrow COMEX positions, whether it's silver or gold. And there was an announcement, which by no coincidence was timed with Powell's speech. And that was on the 9th, with saying that the cost to borrow these positions for COMEX gold and silver would rise the next day on the 10th. Now, whereas as we demonstrated in our last episode, the reason for the House delaying raising margins was to protect very large wrong-footed naked short commercials that's being called for delivery in China, but also that was to meet a large influx of Western ETF demand. We saw exactly the same thing in gold, which better represents the ETF demand. However, trapped between calls for bullion that they didn't have, and that by the 9th of October, just enough naked longs had got on board, speculators who had borrowed gold and silver from the house had got on board, it was deemed to be an optimum point to spring higher borrowing costs on this extremely leveraged group of naked long traders. And we're recording this on Wednesday, the 15th. So following this attempt, following another attempt yesterday on Tuesday, following another attempt today, essentially these rigged pit manager bid pulled events, and that's what it is. They're bid pulling. They know where the stops are, but there's very, very few speculators. There's very little real money involved, and it's really down to how many speculators can they rinse out on the way up. So these bid pull events are both necessary and constructive, serving to rinse out the low-hanging spec froth, which has really coattailed the latest bout of upside momentum in silver and in gold. So to explain what's going on here are the two illustrations we showed when gold was still under 4,000 and silver was still under 48. Now, as you can see, we were questioning why was it that the $17,000 carry cost to borrow a single 100-ounce COMEX gold contract, which was worth at the time $280,000, why had it not risen when gold was trading at $390,000? And then also the $16,000 cost to carry a 5,000-ounce silver contract, and that was at the time valued at $165,000. Well, why hadn't it risen when silver was trading $237,000? And they, of course, have risen since. Now, the reason was because the CME LBMA cartel alliance, which is, as we've talked about multiple times over the year, the London Precious Metals Clearing, LPM and LPMCL, which are the four clearing banks that we've gone over year after year, that we've tracked since their formation, actually since April 2001. These guys, this cartel was on the wrong side of very, very large unallocated short positions. When we say unallocated, we're not talking, they're not one-to-one backed. And these positions were actually being used to report as hedging an equal number of, get this, asymmetrically imbalanced COMEX gold and silver positions. So you've got an unbacked futures foreign exchange position balancing or supposedly hedging a totally imbalanced COMEX gold and silver position. So these are the banks that were basically settling stuff on their own books and then really just having to buy physical when it was absolutely necessary. Now, following a large forced short covering move, now if you recall the Bank of International Settlements having to square shorts at the end of the third quarter, the Fed having to square those BIS borrowings at the end of the third quarter. If you remember, we looked at it. They had to cover them $409 an ounce higher than they had sold it for in the attempts to cap gold, and they were wrong-footed. And that did expose the next 30 tons that they are still outstanding. Well, at that point was going to cost them $4 billion in losses. That's a heck of a lot more now that gold has risen significantly since we illustrated this. Now, the CME finally raised their gold and silver margins, respectively, from 17,000 to 18,000, and in silver from 16 to 17,500. However, the good thing is, other than a dwindling number of speculators, there are very few real money takers. So while the LPMCL cartel has the ability to cash settle unallocated gold and silver by way of literally laying these bets amongst the wider scope of all LBMA member banks, whoever is a taker, very little physical bullion is shuffled into this mix. And if you remember, we talk about sometimes 800 tons a day of unallocated gold getting settled, with maybe 3 to 5 tons ever getting settled at the fixes. However, as far as gold is concerned, the moment that Basel III compliance recategorized gold as a first-tier high-quality liquid asset, gold began to require physical backing at the fixes. However, as far as silver was concerned, this level of discipline was never forced upon the LPMCL, the silver cartel, basically. So the unallocated cash settlement process had continued and continued. And we've delved into far more granular look at how these ballooning undeliverable liabilities began to be called upon by the Asian-facing physical settlement markets, jumping the LBMA ring fence into Chinese physically settled exchanges. Now, don't get me wrong. These 4 banks are not stupid. Each of them are long both gold and silver for their own books, very long for their own books. However, having a footprint in the spot COMEX and the Western-facing Shanghai Gold Exchange international markets, the international-facing markets, it's enabled them to continue to stick handle these ever deeper leveraged underwater bets, which are captured in the quarterly Office of the Comptroller, the OCC report. And it exposes the only central bank that is still short gold and silver is an extremely wrong-footed Fed. However, it was official defense in silver futures that really gave away the scale of global physical supply shortages in physical silver. Now, while both sets of automated gold and silver future spec rinses constructively serve to restore upside physical support equilibrium, these staging points, the ballooning EFP basis spreads, in other words, the spread between the deeply undervalued COMEX futures markets and the much higher priced spot deliverable markets, further exposes COMEX silver is now acting as a price taker and is most definitely being targeted for another backdoor loadout. Now, by last Friday's London Open, lease rates to borrow silver to meet immediate delivery demand spiked way north of 24%. We're using 24%, but it was actually over 30%, driving the silver short squeeze EFP basis spreads that we just talked about. And here we captured it here live at a huge $2.80. That's $14,000 per contract difference. In fact, it has been as high as $3 or $15,000 per contract. Now, the expanded basis spread misplaces the spot equivalent fix. So to illustrate, we spot adjust it in and demonstrate it in green at the fix hours. And as you can see, it is substantially higher than the COMEX, where we actually equivalent to place the equivalent COMEX fix. At the peak, we captured these unprecedented futures backwardations extending all the way through to July 2028. This is mind-boggling. It's unprecedented. It illustrated mispricing COMEX silver market futures are completely broken. The market's broken. Whereas in real time, we're evidencing the SGE-centric, physically settled global spot markets shaking this COMEX tail. It's amazing to me that how few people have actually woken up to this huge breaking of the COMEX. In fact, the SGEI silver prices are setting local London spot prices consistently, one-to-one, mirroring the fresh highs in spot silver as well as gold. So now, Shane, I'm going to move to answer the bulk of all the questions. Why the lower priced CME LBMA exchange for physical basis spreads have been so slow to close. I mean, you're talking about 14, 15,000. Well, why the heck would you just not take that silver and dump it into London and take the profit? Why has it been so slow to close? And in short, the unprecedented supply constraints, there is hoarding alongside strategic positioning around critical minerals leading to global export controls, have left London silver cupboards absolutely bare. Now, worse, unallocated, undeliverable local London FX obligations that had been so-called hedging these COMEX short positions. So when they're called on for physical delivery, these bets in London, these bets are impossible to cover into globally driven, higher physical priced demand. And what it's done is exposed these asymmetrically mismatched LBMA CME derivative bets as naked. Now, these bets are being called in. That's what's happening, threatening default if they're not brought back at higher prices, further tightening supply. Now, these global physical shortages have spilled out into all global exchanges, as exampled by India's Kotak Mahindra haltering ETF investments, as noted here. They were citing a lack of supply at current prices. Since then, UTI, SBI mutual funds, and one others have effectively immediately now suspended fresh subscriptions to their silver ETF fund or funds. You cannot get access to it. London has lost control of the global silver market. We said it last time. It is now so clear it's hard to ignore. Unprecedentedly high risk, unfulfilled local London lease fees illustrate both a lack of trust to lend metal into global supply tightness. So, why you can't trust it? It's too risky. These spreads could be closed at any time. And while registered COMEX inventories appear to be in adequate supply, that is enough to cover a rush of delivery demands, really, as it looks at face value, these leveraged CME warehouse receipts are inequitably hedged against an unfactored lack of local London supply. This is why US lower priced US denominated bullion is slow to be shipped out to capitalize on up to a massively, as I say, attractive $15,000 profit per contract. Silver actually should have immediately been flown out last week, last Thursday, last Friday. 160 SI lots would equal 25 tons. You could put those in on a plane for a matter of a few extra cents per ounce. Yet it was very slow to move. And this is really what we're drawing attention to. And while we're evidencing some profiting from shipping US bars to London, and we'll look at why this will not lower the higher spot price to meet the lower futures price. In fact, the opposite is going to happen. So minor short-term volatility aside, it's the record high global spot prices in every single other foreign exchange currency, no matter which one you look at, across the board, spot silver is at record highs, unlike protected or capped US-centric futures silver. It's so obvious. It's mind-boggling and yet we look at them, listen to Main Street here. I'm on Bloomberg all the time. While they are caught onto gold, they have no idea that the silver market's broken and how undervalued dollar silver is. And that reflects what it is doing is reflecting really the supply shortages, with this effect forcing the US silver prices much, much, much higher. The US is the sole outlier and is being targeted. And while the LBMA clearing members are facing default and are really racing to fly out what little silver bullion they can from the COMEX registered and eligible stocks into London, this is largely serving to satisfy immediate, unallocated, over-the-counter bets that have been called for delivery into empty local London vaults. It's just really keeping pace, trying to keep pace with an immediate default. Notably, illustrating it takes higher prices to bring silver to market. So it's evident this basis EFP spread and lease costs, they expand significantly into lower prices. They contract into higher prices, but literally expand significantly into lower prices. Nobody wants to lease this out. And while inbound US silver shipments are serving to relieve some of the EFP basis spreads between the COMEX futures and spot, currently still averaging a deeply backwardated, I'm looking at it right now, deeply averaging a dollar spread. I mean, that's still $5,000. And we've seen it's about 77 cents into the highs, but today at $1.60 into the lows. So this is plenty of time to have shipped out silver to meet this demand. It's not hard to put 25 tons on a cargo flight. Now, so global physical shortages is really what they're going to do is really quickly absorb anything that arrives in London. In fact, while shipments are serving to avoid an immediate default, the only solution actually is to bring more bullion to market. It would have to be at higher prices because otherwise it's not going to be offered. Now, the PBOC implemented silver export controls, and they're in effect in mainland China. And while these same four LPMCL clearing members are able to access offshore CNH future silver from the western-facing Shanghai Gold Exchange international hubs, the bullion is also being competitively bid to fulfill other global shortages, further tightening supply. Everyone wants silver. So while these inadequate LPMCL US and China shipments may have brought some temporary default relief, the net solution to avoid default is for these silver cartel members to buy back large, unallocated silver exposure with physical at higher market prices. What we're witnessing is an at all cost protection of the officially held COMEX LBMA OCC bets against silver futures breaching very large short stops that have only just begun to be tripped off above the May the 1st, 2011 50 highs, which was here. And notice that the pullbacks have come back to this level. Now these stops, the further up you get here, these stops will ignite, can really risk igniting, and ultimately will spiral into an out of control disconnect versus the globally determined spot silver benchmarks. Very short term, we assessed in our last episode and in the prior ones, while we expect 53 to be the next rally staging post, liquidity providers assess $140 silver would provide the most likely staging point to bring sufficient bullion to market, and it will require sufficient bullion to come to market for the for the short covering to be completed. Now, we were looking at futures, but in the spot market, the real spot market, which is basically driven by every single other currency, FX currency in silver, making all-time fresh highs, we have indeed seen silver testing the 53s, the mid-53s. And it's really this EFP spread, which we're sort of looking at and going to explain better, that is causing this disconnect. Here's a quick example of silver in offshore in the SGEI exchange, the offshore Chinese exchange. And while I'm looking at also gold. So as is evidenced by the unprecedented full spectrum backwardation into as deep as July 2028, mind-boggling, you have to look at it to believe it, and it's improved somewhat, but this is a broken market. And as we assessed last time, even into the 1979 to 1980 Hunt Brothers short squeeze, these sort of backwardations did not exist. And whereas the Hunt Brothers backwardations were able to be contained and cash settled inside the siloed COMEX, where essentially that's where the market was, now the price-taking physical liquidity has been captured by the Western-facing SGEI physical exchanges, influencing every other silver and gold foreign exchange cross. And as we previously ascertained, the quarterly OCC reports, the Office of the Comptroller reports, lists the historically accrued, unallocated, unbacked foreign exchange silver derivative bets being stick-handled for the Fed by the two remaining Fed agent banks, JP Morgan and Citi. Now, do you remember we showed the third quarter unwind of the 5-year derivative bets? That was an important point to note. But actually, out of the 4 LPMCL members, that's ICBC, Standard Bank, JP Morgan, UBS, and obviously, so basically, it's only JP Morgan that provides the only LPMCL cartel member that provides the conduit into the OCC derivative bets. So, you know, ICBC, Standard Banks, UBS, and JP Morgan. Now, notably, and by absolutely no coincidence, last week's rushed together proposed OCC rule, there was a rule change. It slipped under the radar. I haven't seen anyone else looking at this. And what it was doing, it was attempting, this was in a legal announcement, which seemed to be missed by all the mainstream media. It was attempting to rein in bank supervision of exactly these kind of derivative risks. And I just made a copy of it. Quote, federal banking regulators unveiled a pair of proposed curbs on their supervision programs that would formally ban the use of reputation risk. What about people that have been fined close to $1 billion for manipulating silver? Forget reputation risk. As an exam factor, so they remove that, and constrain what examiners can call out for criticism as, quote, unsafe or unsound practices. Going to curb it. Why? There's a panic on. The rule would also encompass unallocated FX gold and silver captured in these quarterly OCC reports. However, given there is simply not enough bullion to meet upcoming delivery demands at current prices, it telegraphs a very, very large move higher. As I say, liquidity providers are assessing $140 an ounce for silver just to meet that demand. Forget anything else. And this is why there's been very few offers to lend silver into higher lease rates. Now, while remaining COMEX speculators have largely been cash settled, and I can see they're progressively, we looked at in the charts, progressively they've been rinsed out. Very large predatory central bank sovereign buyers will force backdoor COMEX loadouts, meaning they'll stand there for delivery, forcing LPMCL actors in related COMEX to buy back these asymmetrically imbalanced bets at substantially higher market prices, further tightening global supply, driving the global price, as I say, much, much higher. So in summary, with every single pulling bank long silver for their own books, every single FX currency, bar the dollar, higher, these unbacked FX silver liabilities undoubtedly sit on the Fed's books. There's just no doubt. And hence the defense of these very large, asymmetrically imbalanced, naked short COMEX hedges that have been left exposed by physical silver and gold being benchmarked against a real global supply-demand price outside the control of the LBMA CME cartel's ring fence. It is this physical market liquidity that is forcing a real supply-demand settlement price to emerge, and it's only just starting to emerge. These official silver futures short stops have sat at the prior silver all-time 2011 highs. We looked at that. And we've seen multiple attempts to defend these short bets with very little speculator open interest able to be rinsed out, which is currently being attempted every day. This will ultimately result in predatory backdoor loadout demands at expiry, as it has every time, but never in this kind of size before, and never with such shortages in the local London cartel. So with China targeting this very attractive underpriced supply, as is India, as is anyone else, very likely we'll see strict US export controls exercised. And perhaps Trump's sudden 100% tariff sanction package, which he announced last Friday, has something to do with this crisis, especially with silver export controls being reported out of China. It's not a coincidence that Trump's sanctions directly followed China announcing fresh export controls on rare earths and super hard materials. And while not specifying silver, we're already evidencing Russian and Chinese military complex, securing as much silver as possible, taking it off the market. Our well-connected liquidity providers assess this is likely why China is not allowing the exporting of silver to profit by closing the futures market's gap. Obviously, anything that's happening in the free trade zone in the Western-facing silver market has had the same actors, LBMCL actors, the ability to actually take some of this and relieve some of the pressure. But it's not coming from the mainland. And while we continue to expect some short-term volatility and more defensive selling, literally by pulling the bids and trying to cap, it's like pushing on a string. It has short-term volatility effects, and they're attempting to fight paper into a tight supply. And they're trying to do it in both gold and silver. It's going to evidence incoming buyers into constructive speculator rinses as the strong hands takes what comes on offer.
All right, Andrew. Now that really nicely covers all the silver questions that we received. And the next part, I guess, is going to be, are there any fourth quarter gold updates?
Yeah, absolutely, Shane. That's another thing. Obviously, I mean, silver. While silver is really in the crosshairs. I mean, it's only because of these differences of this absolute evidence of a broken COMEX market that gold has been less in the crosshairs for. Although I must say, all the Bloomberg for the first time talks about it obsessively, and everyone they bring on, interestingly, they ask the question, "Oh, is it overbought? Is it overbought?" Everyone seems to have that question. Well, it's interesting because almost everyone is coming out and saying, "Well, hey, we didn't have any exposure." So as far as gold's concerned, really, following very similar speculator margin downside rinses we've seen, every subsequent spot gold fix has uncovered very strong, and each one of those fixes have been higher, have uncovered very strong central bank sovereign demand, which is now having to compete with freshly woken institutional ETF demand. Furthermore, this fresh real money ETF demand is coming off a zero allocation basis, with the move to diversify out of dollars, evidencing a growing number of investment banks moving into a 60-20-20, which is a 20% allocation to gold, which is weighing on treasuries, but also severely limiting the derivative-driven gold futures downside attempts. Geopolitical drivers, along with geological constraints to meet physical demand for immediate delivery, suggest gold is undervalued at $5,000. In fact, as we'd assessed last week, a growing number of bullion banks are now joining Goldman's plus or minus 5,000 target, with Hartnett last Friday assessing 6,000. Now, as evidence that the progressively higher Basel III T+1 AM and PM gold fixes, with or without GC, the SGE Golden Week holiday ending last Thursday, it didn't matter whether the SGG was there or not. The FX markets were active, as we remember going through last time. So it just doesn't, as I say, everyone was worried that that would be an opportunity for the Western markets to gain the price lower. It just didn't happen. So what is offsetting this? Because we had a dollar rally too. So obviously you then get an automated, the rising dollar is foreign exchange cross, therefore sell gold. There is that algo in place. But both are safe havens. So very strong central bank sovereign demand is now having to compete with freshly woken institutional real money ETF demand. So when you get a rising dollar price, you're seeing an opportunity to exchange that stronger dollar for a slightly weaker gold, and that is offsetting it. So you've really got both essentially rising together if you take away the short-term chart chatter. And then following Dalio affirming gold as, quote, a safer haven than the dollar. Now, people take him very seriously, suggesting gold is a diversification trade against the dollar. He was supporting a very real money 15% allocation to gold. These fresh inflows of very, very sticky real money really just dived into buy at market. That was one of the last inflection points. Now, Delia's assessment mirrors a growing number of first-year investment banks adopting the outlined 60-20-20, which is 20% allocation to gold. And as is still unappreciated by top callers, wringing their hands over increasingly redundant, far below moving average. And they're saying, oh, but it's the moving averages are so far below. Give your head a shake. That's history. That is when there was these moving averages are anchored in a period when there was literally a a paper market driving the price. And they're sort of still referring to it. And they refer to those, they refer to, well, these are overbought derivative gold positions. But this very real money, very sticky ETF demand is only just beginning to pile into gold, but offers zero allocation base. The race to diversify out of dollars puts gold well in excess of $8,000 an ounce. This visual capitalist zero hedge piece captures the official data that foreign central banks now hold more gold than US treasuries. However, given this official data fails to include thousands of tons of unreported monetary gold central bank buying, and with China alone securing a conservative 80,000 tons, and Russia, India, and Saudi and the BRICS another, between them 30,000 tons, the percentage is likely closer to plus or minus 60% and rising. This is mind-bending stuff. And in the meantime, Chinese and Indian gold and silver buying continues to compete with Western ETF demand. So you've got this concatenation of things going on. So when somebody is not invested, when a Western real money is looking for hedges, they're looking with fresh view, and they just, so what, 4,200? It doesn't matter. This is where I need to start getting exposure, which is why you've got Goldman, Hartnett, and people talking about $5,000-6,000. Now, I know our liquidity providers are busy fulfilling very large spot gold and silver physical orders. We do track them. And they're capitalizing on swapping dollars for gold and silver into really current derivative discounts that we've been offered. The only question remaining is, are you using your dollar, using dollar strength to swap debt-loaded depreciating dollars for real money? I hope so.
All right, that wraps up another episode of Live from the Vault, brought to you by Kinesis Money. And a big thank you to Andrew Maguire for sharing his deep market knowledge, and to you also for tuning in and being a part of this growing global community. Now, if you're new here, make sure you hit that subscribe button. Do it right now, right? And tap on that bell if you want to be the first to know as soon as we go live. And if you've been here with us a while, help us keep spreading the word by, just giving us a like, of course, and share this episode with someone who really needs to hear this information. So get your questions into Andrew. Just look at the link below. And again, you may well be selected for our next episode of Live from the Vault. And with that, we'll be back next week with more truth that you won't find in the mainstream media. And until then, buy physical, make sure it's backed 1-to-1, and we'll see you next week right here on Live from the Vault. Bye for now.